Okay. All right. So we're going to be starting the webinar very shortly in about 2 minutes. We're just waiting for a few more people to get on. And then after that, David will start his portion of it. I see a few of you guys are on. Welcome to our webinar about investing in syndicated real estate. David will be jumping on in just a little bit to start the webinar, but we're just waiting for a few more attendees. So if you can be patient for just about another minute or two, we can get this started. Just so you understand the way that we're structuring this, if you do have questions, there's a Q&A button on the bottom of the screen that you can click on, and then you can type your question in and we will keep it in a queue. And at the end, we'll have about 20 to 30 minutes to discuss questions. And if you do not have your question answered, don't worry, we will be sure to follow up with an email after the webinar. We also have this being recorded for on demand. You can watch it again. We'll be having it at a link on our website and our blog afterward. Okay, guys, looks like we're going to be starting in about 30 seconds here. We just want to make sure that David's all ready to go on his end. And then after David does his presentation, Tom Hahn will be showing his presentation, and then we'll be concluding with Q&A at the end of the webinar. So we hope you enjoy it. And we're just waiting for David to come on.
Okay, hi everybody. Welcome to the webinar on investing in real estate. I've got myself, of course, and Tom Hahn, if you can see the screen from his office. For those of you who know, I'm still in the hallway of my office because of Hurricane Florence. My office is still not functional, so pardon the interruption if you see people walking back and forth in the hallway there. But we've got a great briefing for you today. I'm honored to have Tom with us. And so we'll go ahead and get started on investing in real estate here. I know investing in real estate has been a great, let me get there we go. Investing in real estate has been a great personal and professional benefit to me. I've invested in a number of properties over the years, as well as helping many clients be successful investing in real estate. So I want to talk about a few things today. Number one is why real estate, some of the risks involved, who should actually invest in real estate, how to design a real estate portfolio, and then finally, what are all the different ways that you can invest in real estate. So I put this slide in here, begin with the end in mind. So this graphic is something that I designed to try to illustrate how investing in real estate works. And you'll hear me constantly refer to the left side of the continuum and the right side. And so as we go through this presentation, you'll understand the fullness of this graphic. But for now, I want to introduce it. So when I say left side, that basically means owning and managing your own property. And then all the way on the right side is investing through a REIT mutual fund. And there are all different ways in the middle that you can invest in real estate. But just keep that in mind. Sort of left side is owning individual properties, and then all the way to the right is going to be REITs. So first off, why real estate? I have 6 reasons here. First of all, it's a huge part of the global market. It offers competitive returns. It offers good cash flow and growth. It's one of the best inflation hedges. It offers diversification to normal stocks and bonds. And of course, one of my favorites is the tax advantages. So let's explore each one of those a little bit more detail. I have listed here what's called the global market portfolio. So at BlueSky, we believe that the first thing you should do is figure out what are all the things that you could invest in. What are those types of asset classes that are very distinct, that offer different risk and reward profiles, number one. Number two, they have to be large enough so that you can comfortably invest in that asset class. And number three, they have to actually offer a prospective return. So you notice on here, we don't have things listed like art or wine or classic cars, one of my favorites. They're just simply not big enough, you know, when designing a portfolio. If someone has a unique niche in that, sure, but we're talking about these large asset classes. You have your stocks all over the world, you have your debt markets, you have real estate, and then you have some of your commodities, oil, gas, timber, those type of things. Those are your basic investments that comprise the global market portfolio. And it's amazing the number of people that leave real estate out of that. On this particular chart, we're really talking about the market capitalization of publicly traded vehicles. So here you can see in North America, about $4 trillion worth of market capitalization of real estate. As we shift over to the next slide, we've got some commercial property here in the United States coming up. It's very hard to estimate the value. You know, real estate, a lot of real estate is held in private hands, and you have, you know, tax value, you have comparable value, you have all sorts of different ways to value real estate. And so it's kind of difficult to figure out exactly how much real estate is out there. This particular estimate puts it somewhere around $15 trillion. So the point of the last slide and this slide is not really, don't get wrapped up in the exact, you know, is it 14 trillion? Is it 16? Is it, you know, the idea is this is a large asset class that is appropriate to consider for most people's portfolio. In fact, we believe at BlueSky that everyone should at least have publicly traded REITs in their portfolio. So today we really want to talk about the other trillions of dollars of value that is what we would call private real estate, not necessarily publicly traded. On the return side, I have here a little graphic of investment returns, and you can see that global real estate securities in this column here is very competitive with stocks. Look at the 20-year returns. The NCREIF property database is of private real estate and public. This real estate securities is your public real estate. We also put in here UK, Australia. In our REIT funds, we do invest overseas. And so you can see it's very competitive returns. A little bit simpler graph here. I just have US stocks, US bonds, and the NA REIT equity index. And you can see over 15 years, the dark blue line here, the REIT index outperforming the other asset classes. Of course, just about everything has underperformed the S&P 500 the past several years. That's not always the case, but certainly if you're looking at the bond market, REITs offer a very attractive return over bonds. The next thing we want to look at is cash flow and growth. So at BlueSky, we believe real estate investing is fundamentally a cash flow investment. We do not like speculative things. We don't like raw land. We want to see cash flow. And so real estate collects rents from either tenants or office tenants, apartment tenants, pays its expenses, and then distributes the remaining to the owners of that property. So it creates cash flow. The same thing with REITs. lots of dividends paid out by REITs. The other component to real estate return is the growth, the increase in the value of the property. Now, historically, real estate has increased at somewhat above the rate of inflation. You know, how much depends a lot on the location, you know, some areas more than others, but generally speaking, real estate has shown to increase at least, if not more, the rate of inflation. Then on top of that, you have the opportunity to add value to the property and increase the value of the property, as Tom and his crew do, to when you ultimately sell it, to obtain a capital gain. Now, a lot of the growth potential and appreciation potential in real estate is made when you buy it. So making sure that you buy the property at an attractive price is very important. This is one of my favorite slides. We're talking about inflation. And, you know, for those of you who've been around for a while, you know that the corrosive effects of inflation eat away our purchasing price over the years. And so when looking at different investments that hedge inflation, there's a lot of things thrown about. And I know that, so I've listed here some of the things that are typically cited as good inflation hedges: REITs, commodities, tips, stocks, and gold. And we looked at the data on these, and instead of just looking at the correlation to inflation, we looked at the actual returns. You know, how well did these particular investments do in times of inflation protection? What's interesting here is TIPS, which stands for Treasury Inflation Protected Securities. While their sort of batting average is above 50%, it's actually less than REITs and less than commodities. Stocks also provide some decent inflation protection, and the oft-cited gold is actually batting less than 50% for inflation protection. So we think real estate offers a very good opportunity for inflation protection. Diversification, this is the measure of how much, when, you know, stocks are going up or down, or bonds are going up and down, how correlated is real estate to that? So we have two different components here. Number one, private real estate, and number two, listed REITs. And you can see there are very low correlations to stocks, bonds, and listed REITs. So when designing a portfolio, having asset classes that move differently than each other is very important. You know, 2008, people that had prudently leveraged rental properties, you know, should have suffered no harm at all, while the public markets were declining significantly. So it adds a good diversification to one's portfolio. Now, my favorite benefit of real estate is tax. And I love this little cartoon. You know, for most people, none of this stuff makes any sense, and they have to hire an army of CPAs to try to figure it out. Well, we're going to give you some really good tax benefits of real estate today. So number one is business deductions. Whether you own the property directly, or if you own it through an entity of some type or a group like Tom, somewhere at some point there is a deduction for all the money that is spent in developing that income. And so it's considered a business, investing in real estate, and it allows for different write-offs from the income before arriving at the taxable amount that you have. Number two is capital gains. You basically get tax-free growth. If you buy a property for $1 million and it appreciates in value, there's no tax on that gain. Similar to a stock, it can grow tax-free. And when you sell it, if you want to pay the tax, we'll talk about the 1031 exchange in a minute, but is subject to preferential capital gains rates. In fact, if you take someone that earns $100,000 a year at a job, or a business owner or something like that, versus somebody that earns $100,000 a year in rental income, gross rental income, typically the person with rental income is going to pay a far lower tax bill than the person with ordinary income or business income, because of the preferential treatment of it. One of the big components of that is number three, which is the depreciation. When you buy a building for, say, $1 million, if it's a residential, you get to write the cost of that off over 27.5 years, or commercial buildings over 39 years. Now, where those numbers came from, honestly, don't really know. Somewhere at some point, somebody computed The average life of a rental, a residential rental, at 27.5 years. The neat thing about depreciation, it's a non-cash charge. You don't pay somebody that money, but you get a deduction for it. And so what that does is the cash flow that you receive from rentals is generally going to be higher than the taxable income that you actually pay on that property. Now, there is something called depreciation recapture. We don't have time to get into it today, but if you do sell a property, that those deductions for depreciation you took are subject to recapture and taxation. However, if you look at number 4, the 1031 exchange is a way to avoid the taxation on property. And Tom will get into this a little bit more, but basically, if you own a piece of real estate and you decide you want to sell it, you can roll the proceeds from that sale into another property and pay no tax on that. So you can continue to defer the gain on the property. It's a very tax efficient way to invest. It's called a 1031 exchange. Once again, there are a lot of rules to follow and different things, but for today, just understand that you can take the gain from one property and continue to move it to the next without paying tax on that. Okay, part 2. No self-employment tax. So if you work a job or you own a business, you pay FICA, Social Security and Medicare. Rental income, you do not pay Social Security or FICA tax on that. Number 2, the tax-free equity growth. Like I mentioned already, when property appreciates, you do not have to pay the tax on that. There's another way that a component of that also is if you have financing. Let's say you borrow $500,000 for that $1 million property, and it goes up to $2 million. Now you can refinance it, say for $1.5 million, and take out $1 million tax-free from the property to go do something else. Now you're paying more interest, don't get me wrong, but that's one of the advantages of real estate is you can extract equity from the property tax-free and go do something else with it. The last 2 tax advantages are relatively new. TCJA, that stands for Tax Cut and Jobs Act. It was passed in December of 2017. So there were a couple of goodies in there for real estate investors. Number 1 is REIT dividends are now eligible for a 20% tax deduction. So off the top, just one of the things they put in there, there must have been a lot of congressmen that owned REITs or property or something, because they now offer a 20% deduction for REIT dividends for all investors. Number 4 is the same principle. Section 199A is the 20% tax deduction eligible to business owners. It's kind of the same as the REITs, but they specifically outlined in the tax code that REITs were eligible for the 20% deduction. All rental property businesses are also eligible for the 20% deduction. So for example, if your net income from real estate was $100,000, you will automatically get a 20% deduction from that, making your taxable income $80,000. Now there are some complicating rules. Once again, I can't get into that today to make sure that you qualify for that, but real estate is a qualifying business. If you hit certain income thresholds, there are some additional qualifications that you have to meet. But suffice to say, there's some additional tax benefits that just came out in the tax reform of 2017. So there's a lot of tax benefits there. It's one of the hallmarks of real estate investing. Okay, everything is not risk-free though. There are some risks to investing in real estate, and the number one thing, every real estate investor that I've ever met that's got into trouble has generally been because of the number one thing: too much debt. They finance the property at too high of a debt to equity ratio. 95%, no money down, 100% financing. Great way to get yourself in trouble with real estate is a lot of debt and no reserves to back it up. So that's number 1. Number 2 is the overall economy. You could own an office building in, well, let's just say you owned some land in Ohio near the GM plant that was just announced was closing down. Maybe you owned, the local Dollar General. So the overall economy can have an effect on that. Now, as investors, we want to make sure we're diversifying so we can help mitigate that, but that is a risk involved with an individual property. Number three, mismanagement. You know, if you have poor management of the property, it's certainly a big risk. Environmental. We just had a major hurricane here, Hurricane Florence. Some things you can't control. Maybe there were underground fuel tanks stored on your property. So environmental risks are always a big one. This is my favorite, speculative deals. People come to me all the time and say, well, there's this piece of land and we're going to build, you know, a new Taj Mahal out in rural North Carolina, and we just know that it's going to work. In fact, for those of you that ever drive on I-95, there's this place outside of Roanoke Rapids that is like this theater in the middle of nowhere. And I just look at that. I've never seen an actual car there. I've never seen anything. It's just a bunch of street lights in this huge building. So speculative deals gets people into trouble. Leave that for people that sort of, you know, have a high risk appetite. And then the last one, another risk, is confusing investing in real estate with a business. So there are people like Tom, and you know, we actually have some clients that's their business. That, you know, the business is real estate. There's a big difference between if that's your business and you're investing in real estate, and we want to make sure that you don't confuse the two. Okay, this house flipping. You know, house flipping is a big, you know, a lot of people doing house flipping. Well, that is not, you know, you can see they're trying to flip the sandcastle on the sand. It's always buyer beware in real estate, and make sure you know what you're getting into. Okay, now let's move into the investor profile. Who is investing in real estate right for? Number one is you have to have your core investing and financial plan in place. And of course it depends, and I'm just kind of throwing that out there, but at least 500,000 liquid. You know, somebody I see all the time on message boards and the internet, people, you know, they have $5,000 saved up and they want to go out and buy a rental property. Not a great idea. Have that core investment and planning in place already. Make sure you understand the process and risks. This is not clicking a mouse button and buying a stock. I recommend that you have an advisory team to assist you. You know, someone like BlueSky, a CPA, people like Tom. For some syndicated deals and these private deals, you have to be an accredited investor. You have to have a net worth above $1 million, excluding your home, or make between $200,000 if you're single and $300,000 a year if you're married. And then, of course, watching those debt to equity ratios if you're buying it yourself. Real estate and IRAs. This is a question I get all the time. I'm not a big proponent of investing in real estate with your IRA. You can do it, but consider the fact that real estate is already really tax efficient outside of an IRA account. Plus, all that great cash flow that it throws off is restricted until you're 59 and a half. You can't take it out. And just the complexity and the additional fees, and of course, if you accidentally self-deal with your IRA, you'll invalidate the whole process. So you can use an IRA or a qualified plan to do it, but we typically want people to have money outside of that to invest in real estate. Asset allocation. You know, it depends. This is where your team is going to help you design a strategy, but we typically, you know, the ancient Talmud, my adaptation of that, where they said, you know, let every man divide his money into 3 parts, a third in land, a third in business, and a third keep in reserve. So we've kind of modified that, you know, a third in paper assets, stocks, bonds, public REITs, a third in income producing real estate. And then if possible, if people own a business or something like that, some type of ownership in a business. But it really depends. But, you know, nothing wrong with somewhere between, you know, 10% and a third of your money in real estate. So now let's talk for a few minutes about portfolio design. So when designing a real estate portfolio, we want 4 things. Number 1 is diversified by strategy. Number 2 is by type, location, and vehicle. So there are different strategies. A core strategy, which is your solid, maybe typically Class A buildings. A value add, which is what Tom and Prudent Growth do. Properties that are good, solid properties, but have a little bit of an opportunity to add some value and get a better rate of return. And then opportunistic, which we typically don't recommend. These are, buying a piece of land that you're going to develop a property on. Different property types. They're all different types of property. Some of my favorite are multifamily, office, those type. Although, there are other different types. Mobile home. I know some people that have done very well in mobile homes. Mini storage. All different types of rental property, and they have different rates of return. They have different risks. And so we would advocate that you have maybe not one of every different type, but you don't want to own all apartment buildings all in the same area. So these are just some of the real estate sectors and REITs. Once again, different types of real estate. So that kind of brings us close to the end here, and I'm bringing my chart back up. So we want to talk about the different vehicles to use to invest. As I mentioned already, on the right-hand side of the spectrum, you have REIT mutual funds. If you're a client of BlueSky, you have these in your portfolio. We recommend that everybody have diversified REITs. Own a portion of all the big Class A, big REITs in America and around the world. As you move to the left, individual public REITs, these are just the REITs that make up the REIT mutual fund. You have private REITs, syndicated properties, or what I call in the middle, which Tom's going to talk about. Hired management or turnkey properties. These are companies that will go find a rental property, they'll fix it up, they'll get a tenant, and then they'll sell it to you as an investor. And then over on the far left is to go out and buy, own, and manage your own local property. So you'll see that on the left-hand side, there are higher possible returns. On the right, you're going to get average market returns. But on the left, the most experience is required, the most hassle. You have the least diversification, least liquidity. Now you get the most tax benefits, you get the most control, and you have the fewest layers of fees. Over on the right, it's kind of the opposite. And so our sweet spot really is in the middle. As I said, the left side, to me, is can you spell headache? I have a saying is, if you own your own property, it's the F's. Find it, finance it, fix it, find the tenants, fight with the tenants, file for eviction, fix the property, find some tenants. It's just this constant cycle of the F's. If you're going to own your own property, please at least get some professional management or possibly a turnkey property. Over on the right side, REITs are not a monolithic group of investments. They range from public REIT funds to individual REITs to private REITs. I have a little comparison chart here for different types of REITs, but you don't have to understand all this completely, but just understand that when someone says there's a REIT, there's a big difference between a publicly traded REIT over here that's open to any investor and a private non-traded REIT for accredited investors. So just make sure that you're aware that there are different types of REITs and the different characteristics of those. So now there are lots of choices in the middle. And, right now it seems like everybody and their brother is out there crowdfunding some real estate deal. I mean, you can't trip over a rock. My inbox every day, I probably have at least 3, 4, 5 people putting together a real estate fund. And so you got to be very careful in the middle with syndicated deals. Now, syndicated properties, private sponsor-led, private partnerships, they go by different deals. I kind of use the term syndicated properties, but to me, it's the best of sort of that, both the left and the right side of investing. It affords those higher returns, but the key to me is that as an individual investor, you're not personally liable for any debt on the property. And that to me is a very clear line that separates the left from the right side. And really syndicated properties to me is as far left on the chart you should go, unless it's your business or you are the main tenant in the business. So for example, at BlueSky, we own our building here in North Carolina, but we're the main tenant in the building. So with that, I want to introduce Tom Hahn of Prudent Growth Partners. So I met Tom several years ago, and he has put together one of the best groups of people to invest in. Now, I need to mention, as you know, at BlueSky, we're a fee-only advisor, and our only compensation comes from our clients. We have no financial arrangement with Tom. We don't get paid for our clients being in these deals. It has no financial incentive whatsoever for us, for Tom. What I've done is I've worked with a number of people across the country and these type of things, and Tom and his group and the deals that he finds and the ease at which he is to work with and the way that he treats our clients is just phenomenal. And so rest assured that we've chosen Tom as one of the people that we work with in this space, just from a pure fiduciary standpoint, that we think it's the best, one of the best groups out there to work with. So with that introduction, I'm going to stop, Tom, and if you want to take over and go ahead and.
Yeah, great. Thank you. Can everybody hear me okay? I hope so.
Yeah.
David, you got me? Okay, great. Let me start my slideshow here. So first of all, thanks for the introduction. Excited to be on the call here today. My name is Tom Hahn. I run a company called Prudent Growth Partners, and we are a private real estate syndicator, very similar to what David was talking about on the left side of the scale. You want to flip through here. Our mission as a firm, the reason we exist, is to provide what we believe to be exceptional long-term results to our investors through the acquisition, management, and liquidation of commercial real estate assets. We don't only do multifamily. That's probably our preferred class. We'll talk the different segments we like to focus on, but it's all about driving value. As a quick snapshot, our principals and advisors have combined experience of over 150 years in real estate, private equity, and financial markets, capital markets. So we're very comfortable in the worlds of debt and finance and contract negotiation. Since our formation in 2015 as an entity, we've completed 30 transactions, which includes 8 full cycle projects. And that's important. There's a lot of people out there that can talk about completing a lot of deals, but what they really mean is they've bought a lot, maybe they haven't sold much yet. It's nice to see a sponsor, and it's important when you're doing due diligence on sponsors to look for people that have actually been through a full cycle of buying, owning, and then liquidating. All of our dispositions have achieved better than 20% IRRs, internal rates of return, and most of them even better than that. Our current portfolio value, we're small, deliberately smaller. We'll talk about that in a minute, but we have $105 million in real estate, $43 million in equity, with about 60% debt to equity ratio, which we view to be conservative. As David said, it's important to really monitor your debt levels in real estate. Our plans for next year are to raise $25 million, maybe $30 million of new equity. We hope to complete $75 million or so in new acquisitions. Some questions I want to answer today, and a lot of them David's already covered, so I'll move kind of quickly through some of the basics, but we want to talk a bit about why commercial real estate, maybe why now, given where we are in the cycle. Have a quick conversation about interest rates, and then talk a little bit about prudent growth specifically. As David pointed out, and some of this is going to be repeat, but real estate is non-correlated to the public markets, which I think is really, really important. It also outperforms almost all other asset classes on a risk-adjusted basis. It's universally regarded by just about everyone as an excellent means of long-term wealth creation. And I like the third analogy from the Talmud that David had, and I read an article the other day from Tiger 21, which is a high net worth association, and the single largest asset allocation of their members was real estate. It was about 31%, and the second largest allocation was private equity. So you can think about that as private business ownership, and that was about 25%. So, the wealthiest in our country, about 2/3 of their investment allocation is really real estate and private equity, with the remainder in publicly traded securities. The other thing about this chart that reinforces is the difference between public REITs and private real estate on the left. Public REITs tend to attract kind of that fast money. You're in and you're out. They're more volatile because they tend to move much more quickly with moves in interest rates and expectations in the markets. Private real estate, I think, is more appropriate to own real estate. It's a longer term vehicle. You're not marking it to market every day, and you're really focused on creating long-term, wealth through the proper management and investment in the asset. So I think that there is a trade-off with less liquidity, but I think it's in this asset class, I think it's a trade-off that's worth making. Next slide is just real estate in general. There are some interesting demographic factors that over the last 15 years that we've seen as a country that really support it. People talk a lot about the rise of the renter class. You're kind of bookended here with millennials on one hand who desire mobility and they prefer to rent. Many of them have student debt. Many of them have seen their parents or grandparents or aunts and uncles lose money during the last downturn when a lot of people got hurt with their own private residential real estate. So they want to rent. They need to be able to move. They just don't want to be tied up with a home. And on the other end, you've got empty nesters and folks that are aging out of their homes that also desire a lot of mobility. They don't want a yard. They don't want all that stuff. So they prefer to rent as well. In the middle, and that's a demographic I don't think is really going to change anytime soon. It is interesting. We are watching at what point do millennials begin to say, I want to get out of an apartment and own a house. But the jury is still out. But there's no question that it feels like it's a little bit different this time that we've maybe seen in the past. Economic and population growth, specifically in the Carolinas, which is where we focus, is tremendously supportive of real estate. We are outperforming the gateway cities from a population growth standpoint and a price standpoint. And, we've got a diverse economic base here in the Carolinas with medicine and universities, healthcare, technology startups, manufacturing, agriculture. And as a Sunbelt or Southeastern state, we're really benefiting as well from a lot of retirees relocating here. So all very supportive demographics to what we're doing, which is really important with real estate. And the final thing is the 2017 tax law, and a little bit of a different angle, aside from just the tax advantages of real estate, the fact that the tax law so dramatically changed the state and local tax deductibility by putting a cap in place, as well as the substantially higher standard deduction, that just once again removes two big reasons for wanting to own your home. So for the lower to middle income demographic, I think the argument to own real estate is a really difficult one to make with a $24,000 standard deduction now, and with a cap on state and local tax deductibility. Very few people are going to be itemizing deductions in that income bracket, which is an area that we tend to focus on. Some real estate is more attractive than others, in my opinion. There's a lot of money chasing real estate right now. There's a lot of large institutional buyers. There's, 20, 30, $40 million deals are happening frequently, and there's a tremendous amount of competition in that price point. We like to look at what I call Goldilocks investments, stuff that's too small for the larger buyers, but also a little bit too big for the smaller guys. Our typical deal size on the whole property is maybe $3 to $7 million. We've bought larger than that, but typically it's at $3, $4, $5 million price point. We are focusing in the Southeast, North Carolina, South Carolina, Virginia, Tennessee. We only own right now in North Carolina, Virginia, but Tennessee and South Carolina is an area we're looking at. We find higher returns, better demographic trends with these smaller deals. We like the secondary and tertiary markets. So rather than being in Raleigh, we don't mind being just outside of Raleigh or just outside of Charlotte. We're typically buying Class B or C properties, which means if you're thinking of an apartment, picture a suburban garden-style apartment as opposed to the brand new stuff that's getting built. These assets we can buy well below replacement cost. There's usually ample opportunity for value-add strategies, and they tend to be characterized by lower turnover, higher occupancy, and resiliency in different economic cycles. Here's another slide just showing real quickly the difference in cap rates between kind of the major markets and secondary and tertiary markets. And I'm going to just pause and explain real quick, if you're not familiar with that term. The cap rate is simply like the bond yield. So it's the net operating income of the property divided by the purchase price. And so obviously the higher the cap rate, the more that property is going to throw off in terms of cash flow or net operating income relative to the purchase price. So low cap rates are expensive and high cap rates are inexpensive. And as you can see from this bottom left-hand chart, the gray line, the tertiary markets, these are your smaller towns, 50, 75, 100,000 person town. And you tend to get higher cap rates there because there's a lot of large institutions that simply won't buy in a major market or in an MSA with fewer than maybe 250,000 residents in it. So we find for us being buyers, the product availability and the yields in these smaller submarkets are really attractive. It is important, though, to understand those markets, and that's why we're staying close to home by focusing, primarily in the Carolinas. Right-hand chart, the declining share of Class B and C inventory. It's a really important note. A lot of people will say, well, man, they're building apartments all over the place. Aren't you worried about oversupply? And, yes and no. I mean, if you look at the third line down, there's Charlotte. And this chart's about a year old, but you had a huge year-on-year change in Class A inventory, 68%. It was from like 2016 to 2017, and 1.3% gain in Class B and C. Some markets in Birmingham and Alabama or Atlanta, you see a negative change in Class B and C inventory. And the reason for that is, quite frankly, you've got either urban core, where it's just gotten so run down that it's being demolished or condemned, or people are buying kind of like a B or B plus property, investing a tremendous amount of money in it, raising rents and turning it into an A or an A minus. So the scenario that we see is all of the building, all of the construction is Class A. Very few people are building at the price points that we're buying at. And that's a huge demographic. I mean, the working class demographic in this country is growing, and the supply is simply not there. And this is a wonderful slide that just shows how Class B in particular tends to be considered. Most people talk about that being really recession proof. In economic downturns, you can see people moving from a Class A to a Class B in order to save some money. You may not mind a 15-minute longer drive if you can save $300 or $400 a month on your apartment rent. In economic boom times, people tend to trade up, from a C to a B. This same dynamic holds, incidentally, I think, in office and in retail. And we like both of those asset classes as well. You'll tend to have, smaller firms, CPAs, law firms, service providers that get out of a really expensive building in a downturn and they look for a less expensive office space to rent. So we really resonate. For us, it's kind of that C plus, B minus property is what we're looking for. We do focus on value add. Every property we buy generally has a value add strategy in it. That can either be physical value add, it could be, redoing the parking lots, new roofs, windows, siding, landscaping, or it could be operational. Maybe new management, better expense management, better contractor negotiations, marketing. You'd be amazed, a lot of the properties we buy, if they're family owned and operated, there's frequently tremendous kind of easy, low-hanging fruit where we can shave a lot of expenses off of a property and improve the operations. So you can see on this chart, the return is solid. The risk is modest, and development, it will always have your highest return. But like David said, you get into development, ground up stuff, buying land, significantly more risk there. What about interest rates? It's a hot topic right now. I will say everyone in our space is talking about it. Are they going up? Are they going down? When I did this slide a couple of weeks ago, started working on these, everyone was thinking about rising rates, and now they're coming off again. I think this chart is very telling. It shows what the change in the cap rate. So effectively, the average yield of real estate. As you can see in 16, at the end of 15 going to 16, the Fed began raising their short-term interest rates. And since then, the bottom part of the section, you've got apartments in the orange line, office and retail and industrial. Those cap rates have actually, the average cap rates have actually continued to go down, or certainly in the case of office, let's say, and retail remained fairly stable. Hotels gone up a little bit, but even that's had no real substantial change. And I think that's just evidence of the fact that, well, let me go to this next chart, kind of tell us the story. this chart shows the spread between the average cap rates, the average yield of these different real estate sectors over the 10-year treasury. So, you know, back in 13, 14, 15, the 10-year treasury yield had gotten so low when it was trading, you know, 175 or 2%. You know, the cap rates were hanging out 6.5% in most of these product types. So the spread was about 4 percentage points or 400 basis points. That was actually fairly wide by historic standards. And all that's really happened here in the last 12 months or so is, you know, some of these interest rate curves have started to revert back towards more of a normal level, or what might be a normal level. We don't even know. But it really hasn't impacted the cap rates in real estate. You know, people are still happy to earn 6 or 6.5 or 7% on a lot of these real estate classes. And just because the 10-year bond goes from a 2% yield to a 2.75% or even a 3.25%, you know, the returns on real estate are still very, very attractive. And we'll come back to that if people have questions. This next chart is an interesting one. This is non-residential construction deliverables. So as you can see on the left side of the chart, from 03 all the way up through 2008, you had a tremendous amount of real estate being built. You know, debt was easily obtainable. We were in a boom cycle in the economy. There was a lot of people leveraging. There was just a lot of stuff getting produced. Office, the dark blue line, that's 600 million square feet of office was being delivered. The line that I like is at the bottom, the gray retail. You know, we were running pretty consistently in 06 and 07 and even into 08, 200 million square feet of retail being built in this country. And you can see everything fell off like a cliff. And retail is the one that it's still, I mean, really from 2010 all the way through to the end of 16, nothing. We're delivering 50 million square feet a year. What's starting to happen now, finally, is you know, demographic growth and business growth, particularly in an area like the Carolinas, has kind of caught up to that. And we now have, you know, vacancy rates have really dropped. Certainly around here in the Triangle, the Raleigh-Durham area, Charlotte, vacancy in retail and office and flex space is very, very low. So it's very supportive for existing asset values. Something that I like to look at, I love technology. And I know for a long time as an investor in real estate, I had the perspective, and I think it was a correct one, that these smaller properties were more difficult to manage, which they are, more expensive, or they were, I should say. But there's been tremendous changes in technology. It's driving efficiency, reducing costs, improving communication, both in the buying of these properties, the managing of these properties, communicating with your tenants, with your vendors. Everything's in the cloud now. Everything's app-based. It's just like every other aspect of our economy, technology is driving down expenses. And I think the market still hasn't quite caught up to that yet. You know, we use third-party managers for all of our properties. And these are systems that they tend to use. So AppFolio, RentTech, PropertyWare, these kind of systems really reduce the cost of these smaller properties. So the fact we can buy them at such attractive returns is even better. People are noticing this. I just grabbed a few headlines. Some of these are a little bit dated because this is from an older slide, but the one on the left here was just from this past November. As a real estate cycle winds down, might be a good bet. Millennials are expected to keep moving to the suburbs. I mean, you can see strong demand for Class B apartments. Class B offers choice investments. Stronger retail demand and rent growth seen shifting to second-tier markets. This is a common trend. I mean, people in our industry understand that B and C, value add, secondary, tertiary markets are really, really attractive right now from a yield. The problem is they just have trouble executing on that. If you're like a New York-based fund and you've got to try to put $100 million to work next year, it's hard to come into the Carolinas and buy, you know, that's $100 million in equity. So you got to buy like $400 million in property. And, you know, some of these shopping centers only cost $3 million. So these guys just don't have the capacity to come in and buy 150 individual deals. So there's a lot of hand wringing and just, you know, just desire among these larger institutions to get into this space, and they just haven't quite figured it out yet. So we view this as an opportunity. In our view, the opportunity is to acquire a diversified real estate portfolio at very attractive yields over larger publicly traded kind of returns. I do think eventually these larger institutions are going to figure it out. They'll be buying portfolios of properties. They'll be partnering with guys like me. We certainly get calls from some of these outside groups looking for product, looking for deal flow. But there's still a huge, I think, window to invest. Our focus, our key markets are really doing well. We're seeing a constant, source of deal flow. I don't see that tapering off anytime soon. And lending rates are still near multi-decade lows. I mean, even with the little bump up over the last, 6 months, I mean, we're still, so we went from like 4.5 to maybe 4.85 on our, debt. I mean, it's still very attractive. 3 primary sectors we focus on: multifamily, neighborhood retail, office, and flex, all with similar acquisition criteria. As we've already said, we like B and C. We like the Carolinas. We're buying higher than average cap rates. We're very disciplined on our acquisition criteria. We're always buying below replacement cost. We always have a value add strategy that we identify. We always like stabilized cash flow, where we can do immediate cash on cash returns to our investors. Almost everything we buy is off market, which means we're getting looks at deals before they go to the market. So we get much less competition that way. I'm not going to go through all this right now in the interest of time, but this just reiterates some of the things that David talked about with private sponsors like ourselves. We have access to deal flow. We provide expert due diligence. We provide true diversification from public securities. It's passive income, non-recourse to the investors. It's an institutional quality offering and process, and we have some really solid proven results. Our typical deal structure, and this is the case with any kind of syndicated deal, we have an owner, we'll buy a property, we'll find a property, an apartment community, let's say. Our ownership entity will be formed. Single purpose LLC, we tend to work with accredited investors only. It's all non-recourse. We're always investing alongside. We can work with people that have 1031 money to invest. Our distributions are paid quarterly. They are offset by depreciation and all the other tax advantages of real estate. We always have an 8% preferred return to investors. So investors get the first 8% of any cash flow from the property. And then anything over that is 75% split to the investors, 25% split to prudent growth. Our returns typically will model out at 9 to 10, 11, 12% in terms of cash on cash. Our IRRs tend to be 15% or higher. And we typically will project an exit in 3 to 5 years, but we definitely have exited earlier on several deals where we've seen an opportunity to do so. This is just an example of how a deal kind of moves through. And just quickly, I mean, prior to going under contract on a deal, because practically speaking, there's a lot of moving parts here, and it's important that investors understand this. We'll be forming an LLC, negotiating contracts, starting initial due diligence. We have our own investment committee that will approve the investment. Once it looks like the deal's going to be going, we'll be preparing offering memos, soliciting interest from our investors who have invested with us in the past. We also like to leave room for new investors where possible. We'll be doing all of our due diligence, our debt negotiations, management negotiations. We then acquire the property, and prior to that, obviously, all investor documents are executed. We have an online system to do that using DocuSign and an investor portal. Everything's onboarded. We then take the property over during the initial ownership period, and we begin a lot of our value add strategies. I prefer to do a lot of our value add early on in the process because let's make the property look as nice as we can, as quickly as we can. It's all about driving rents, driving occupancy, and driving returns. We're very active in our management of the property. We work closely with third-party managers and on-site teams. And honestly, sometimes this market's very hot right now to a certain extent. So, we'll almost start thinking about dispositions usually about a year and a half after buying a property. We'll at least start thinking about it. And in some cases, we'll be getting calls from brokers and unsolicited offers, in which case we immediately begin communicating with investors about a potential sale should that happen. There's a lot of negotiations that occur at that point and 1031 planning. prior to this disposition, investors have an option to stay in the deal or leave the deal. We can talk about that a little bit more in Q&A, but we always try to execute a 1031 because we're investors as well, and we love that aspect of real estate. It's an important way to defer taxes. And if we do execute on a 1031, we'll find a great replacement property, and then we repeat the cycle. We've talked a lot about 1031. I don't want to spend too much time here. I will point out the third point down. There's some neat stuff you can do as an investor in an LLC when you're doing a 1031. If you do want to try to pull out, but you still don't want to pay the taxes, there are opportunities to donate your shares into maybe a charitable remainder uni trust, an outright donation to a charity. You can gift the kids. I'm working with an investor right now who's donating some LLC units into a donor advised fund, and it's a little bit of a complicated transaction. I'm going to make that happen for him. So we love that. We love working with guys like David on tax strategies like that. Real quick, two actual case studies just as a way of examples. Willow Woods was an apartment community we bought in October of 16, and we sold it in July of 18, so not quite 2 years later. Just cutting through the chase real quick. I mean, we bought it for 5.6 and we sold it for 7.15 million. It was a very solid return for our investors. It spun off, about 9% a year in 16, 17, and 18 on an annualized basis. The overall IRR on the deal was 36%, very strong multiple. And that the proceeds from this property were rolled into several different deals. So it gave everybody some diversification. We ended up selling the property and rolling part of it into a Class B office complex in North Hills, a nice part of Raleigh. We bought a shopping center and we bought an industrial flex building. So great transaction. I'm very pleased with that. And it was an off-market buyer that came to us through a broker relationship I have, and they were willing to assume the debt, which was a more complicated negotiation, but it really saved us a lot of money because there was a fairly large prepayment penalty on the loan. Hope Valley Point was a retail deal. We acquired it in November of 15. This was a textbook study, in my opinion. We sold it in August 18. We bought it for 1.9 million. We sold it at just under 2.8 million. This was a distressed seller. It had probably 30% vacancy. He didn't have enough money to really pay leasing commissions or to offer any kind of tenant improvement dollars to prospective commercial tenants. So we were able to come in. We had all the funding that we needed. We always raise all the money up front for any kind of planned value add and re-tenanting expenses. We filled it up. We cleaned it up. We ran it for a couple of years, spun off some great cash flow, and then we started getting phone calls on it. And I sold this directly to a 1031 buyer. There was no broker involved, and he also assumed the debt. So this was a 30% IRR, almost a double at the equity. And these are at the investor level. So this is after all fees and splits and transaction costs. And we 1031 this into a very nice larger shopping center in Garner, North Carolina. Here's our team real quick. That's me. Rainey Sellers in the middle runs investor relations and a lot of our equity. David Miller's our general counsel. Tim Oakley is our CFO, and David Pierce. And that is the end. I tried to go through quickly. And there we are. That's my email and Rainey's email there at the bottom on our website. And we are going to pause for questions. So I'm going to, David, I'm going to stop sharing and turn it over to you.
Yeah, thanks, Tom. This is excellent. Yeah, so we do have a few questions. Why don't we get one of the moderators to read them out, and we'll answer them, either Tom or I.
Sounds great. Just want to give you a time warning. We actually have about 3 to 4 minutes left before this webinar will probably close. So just to reiterate, we will send the answers to the questions in an email. But I think one that was a really interesting one that I thought was good was, what happens to my investment in a syndicate if when I die, how does it pass to my heirs?
I'll take that real quick. I have not had that happen yet, but all of our operating agreements contain lots of provisions around the transfer of LLC units and what happens. Typically, yes, you would have the option to pass it along to your heirs. You also would have the option, if you would like to sell them back to the LLC or back to other LLC members. I'm fairly confident that there's a step up in basis. Given that it's a direct investment in real estate, I might want to defer to a CPA on that.
There is.
There is. So that's good. Yeah.
Maybe you could quickly define IRR. I mean, I know what it is, but just we
Sure.
typically use a time-weighted rate of return. So define IRR, please.
Yeah, IRR is something that, we look at a lot of different metrics as well. I actually kind of prefer equity multiple, but IRR is commonly used in real estate, and that is effectively the internal rate of return on your investment dollar. And it's a calculation. It's a little bit of a cumbersome calculation, but the assumption there is that you take the initial investment that you make in the property, let's say $100,000 investment, and then all of the cash flows coming out are accumulated, and then you back into what your internal rate of return would be to produce those returns. I will say there is a time element to it. So the shorter you hold it, the higher the IRR tends to be versus owning something for, say, 10 years. Because the assumption is that the dollars coming out are invested at the same rate of return that is produced, by the IRR. So there's some modified IRRs, another calculation where you might assume that your distributions that you get out are invested in like a money market account, and that would have a slightly different return. But most real estate guys are talking about IRRs, and people tend to look at that. It's a bit of it's just a way to compare apples to apples. It's not my favorite measurement, but we put it in there it's kind of an industry standard thing.
Okay, great. Thank you. Sorry, my mute was not unmuting before earlier. So it sounds like we can probably go on a little bit longer. We're not going to be cut off from our webinar, which is good news. So
can we talk about the 1031? I see there's a question about 1031s.
Yep, please do.
Yep. Let me take that real quick. So the question is, what's the long-term strategy for this kind of real estate investing? Just to keep 1031 exchanging the property into another property in perpetuity? That's an excellent question. The answer is kind of yes. I mean, as long as we can find an appropriate property that we like, that meets our criteria, there's usually a strong preference to roll and to do a 1031. But at every case, and it's worth pointing out, at least on my deals, and every sponsor does this differently, what we like to do is when we sell a property, we will send out, we get lots of communication to our investors, and we'll send out a communication and say, listen, we've sold the property, or we know we're going to be selling the property. Here's what your LLC units are worth. Here's your investment after all fees, expenses, acquisition costs, disposition costs, everything. So if we were to cash out and distribute the equity to everybody, your investment's worth whatever, say 185 grand, maybe at 100 grand in it to start with. You now have a choice to make. As long as 50% of the LLC members want to proceed with a 1031, we will try to do so. The IRS will view our LLC as a continuing entity if at least half of the LLC goes into the new property. So we definitely need half the people. We really need more than half the people because it can get really expensive otherwise. But basically, if everybody wants to go, then I'll say, look, you can either do nothing, in which case your proceeds are rolled into the new property. B, you can cash out some or all of your proceeds. You might have a personal or business reason why you may need access to that capital, in which case you'd be selling your LLC units back to the LLC, and you'd pay long-term capital gains tax and some depreciation recapture at that time, and you'd be out of the LLC. Or C, or three, you could choose to invest more money into the LLC. Typically, when we do a 1031, we might need to raise some additional capital to consummate all of the different transactions, all the different replacement properties, unless it's an exact match. So we might have a couple $1 million in equity coming out of a deal. We identify maybe 2 replacement properties we really like, and we need to raise $2.5 million to buy them. So we're recapitalizing the LLC. People have an opportunity to leave. People have an opportunity to invest more money in. And if we want to, we can even bring in outside investors to help close the gap. But typically, current investors are happy with the process. They're obviously thrilled with the returns. They're looking to put more money into work anyway, so they view the replacement properties like a new investment. And they're like, great, I'll throw another 50 grand in the deal. They don't need to get another K1. They don't need to do another set of subscription agreements. It's a very easy way to increase your investment in real estate. So there's no, it's not necessary to do this in perpetuity. People can take their money out, but as long as we see the opportunity to 1031, we are very motivated to do so. The only other thing I could say is you could also then think about other strategies where if you get a huge capital gain that you've built up over multiple cycles, one common strategy I see guys like who invest in private equity real estate do is donate those units into a CRUT. And David can tell you you have to worry about unrelated business, taxable income. But when you've sold the property and you have yet to purchase the replacement property, there's this time window where no one has taken any constructive receipt of the proceeds. They're in escrow with your 1031 administrator. So that's a very easy time to say, you know what, I got $200,000 worth or $1 million worth of this LLC. I want to donate it into a CRUT, and then the CRUT can elect to take the distributions from the 1031 administrator if we're basically not going to 1031 it. So you get the tax break. The CRUT then can take the money and invest it in a diversified portfolio of publicly traded securities, and everybody's happy. That's just one possible strategy. There's lots of cool things we can do with this.
That's really helpful. And you know what, from a standpoint, a CRUT, can you just quickly explain what you mean?
It's a charitable a strategy for people that have highly appreciated assets, whether it's real estate or publicly traded securities, where you can donate those into, it's basically into a trust. It's a charitable, irrevocable trust. And you can then turn around and have your trustee, you can actually act as a trustee, but you can invest that in a basket of securities, and you get, for the rest of your life, or you and your spouse's life, you can enjoy the income from the CRUT, but the charity eventually gets the principal once you pass away.
Okay, great, thank you.
So we had another question about buying brick and mortar versus purchasing land and leasing it out to developers. So that sounds like a developmental project that we typically would not recommend for our investors. But Tom, is that something that you have ever done?
No, we really don't do ground up development. I have one project. It's a shopping center. There was an out parcel. I kicked around maybe developing it, but we ended up just selling the whole thing to a developer at a good return. I'm not saying I would never do it, but it's a little bit outside of our wheelhouse. I like to say we buy stabilized cash flowing property.
Okay, and the last question was about owning real estate directly in an IRA, as I mentioned, is somewhat problematic. We typically, before the Tax Cut and Jobs Act, would put REITs into IRAs or 401ks where that income that was thrown off was sheltered from taxation. And so the question is, with the new Tax Cut and Jobs Act, of course, rates have come down, number one. And number two, the additional 20% deduction for REITs, does that make them less suitable for IRAs? And what assets would you put in IRAs? And so, yes, it definitely makes the asset allocation decision a little bit more difficult in terms of if you hold them in a taxable account, there'll be less tax owed than last year. If it's throwing off a 5% yield, 20% now, you're at a 4%, effective yield. So I still think it comes down to what tax bracket are you in, and do you need the cash flow or not? But it certainly moves the needle a little bit on the equation as far as putting them into taxable accounts. It's not quite so problematic as it used to be. Tom, do you have any comments on that?
I could not agree more. I think the as you said earlier, the tax advantages of real estate are so good that I would rather see IRA money go into like corporate bonds and other things that are not automatically tax deferred or tax advantaged.
Mm-hmm. Okay, I think that covers all the questions we had. Okay. Well, great. Well, we're a few minutes over, but I think it was well worth it. I know I always enjoy listening to Tom and the great things that he has to say. And thank you, everybody, for joining. We will have a copy of this posted to our website for people that couldn't join. So we'll get that taken care of. And then if you have any questions, of course, contact your advisory team. Or Tom, we'll get you in touch with Tom if it's not something that we can answer. So thank you very much for attending today.
Thank you.
Thanks,
Take care.
Tom. All right.